Welcome to our Columbia Business School Executive Education session. I'm Mark Roberts, Senior Associate Dean, and I'm very pleased to be here with Donna Hitscherich for today's webinar, Discover When M&A is a Competitive Advantage. Just before introducing Donna, I'd like to quickly run through a few logistics. I can confirm for everyone that this webinar is being recorded and a copy will be sent to you via email after the session. Please take note that you can follow us on LinkedIn for the latest business news and updates by searching for Columbia Business School Executive Education. And finally, but really most importantly, please submit any questions you have during the session today, just using the Zoom Q&A box, and we'll try to get to as many of those as possible in the last 5 minutes today. I'm now really very pleased to introduce you to Donna Hitscherich. Donna serves as a co-director of the private equity program and is a Bernstein faculty leader at the Sanford C. Bernstein & Co. Center for Leadership and Ethics. She teaches corporate finance, business law, mergers and acquisitions, and advanced corporate finance. Prior to her academic career, Donna was an investment banker and mergers and acquisitions specialist, working with CS First Boston, JP Morgan, and Bank of America Securities. And prior to those roles, she was a corporate lawyer specializing in mergers and acquisitions. Donna holds a BS and a JD from St. John's University and an MBA from Columbia Business School. She's also a certified paramedic in the state of New York. Welcome, Donna. Thank you for leading our session today, and it's with pleasure that I hand the reins over to you. Thank you.
Well, thanks, Mark. That's great. And I'm so glad you're all here today. And I'm hoping we're not going to need my paramedic skills, so that'll be okay. Well, thank you all for coming today and learning when M&A is going to be a competitive advantage. And it's going to be a competitive advantage when it works. And so hopefully today, I'll spend a little bit of time going through with you a couple of things that I've seen over that career that Mark has mentioned lead me to believe M&A works or it doesn't work. So we have a little poll here, and you'll see a QR code that you can scan. And I'd love to get your view on this about 2024 global M&A activity. Do you think 2024 global M&A activity will surpass that of 2023? And we give you a bunch of choices. So if you scan that QR code there, we'll wait till we get a fair number of responses. So is it absolutely no doubt? Yes, by a small margin. No, it will be lower. Or are you kidding? I have no idea. What do you think? People are still trickling in. You can just scan that QR code. We'll wait till we get a statistically significant size here. We've got 215 people, it looks like, on the webinar. So let's see if we can get 100 responses. When we get 100, we'll call it and we'll see what people think. Okay, just a little bit more. You guys can do it. Just scan that QR code up in the corner. It'll take you right where you need to. You can skip putting your name in, skip registering, and just hit one of the buttons. What do you think? Okay, we're almost there. Critical mass. We said critical mass will be 100. So let's see what we got. Okay, here we go. We just got 100. Oh, there we go, 103. Okay, let's see what people think. Okay. Absolutely no doubt. Okay, yes, by a small margin. And there's a few people that have no idea. Okay, awesome. So about 10% of you have no idea. Okay, good. And we're going to talk about how this ties together in just a second. The second thing I'd like to ask you is if you could this is going to require you to type an answer here. It's the same place you're in. This question should show up on your phone. What is the role of the investment banker in a sell-side process? Role of the investment banker in a sell-side process. So we had a fair dispersion of what people thought in terms of M&A activity going forward. I'd love to see what people think the role of the investment banker is in a sell-side process. What are they doing? Let's type in a one word, a phrase, maximizing value. Okay. Pushy, somebody saying pushy. Okay, awesome. Optimization, expectations, money. Okay, great. Okay. Well, I'm very, very heartened by the fact that, a couple people have said it. I'm very heartened by the fact that we have responses other than valuation, because one of the first things, hopefully, that you'll walk away from this webinar with is something is worth what someone will pay. So if you think about the role of the banker, at least from my money, the banker is thinking about the client's objectives. What is the client's objective? And we oftentimes think that it's maximization of value, but it might be value at a certain speed, right? The ability to divest of a particular asset for whatever reason. So there's the motivations that the seller has, right? So thinking about the seller's objectives and their motivations, thinking about the nature of the asset. There's no requirement that we actually run an auction for the sale of any asset. We could do a privately negotiated sale, right? There's no reason to have an auction. So we're going to be thinking about what the client's objectives are, as well as the nature of the particular asset. And then we're going to be talking about the market conditions, okay? So when you think about the client's objectives, the nature of the asset, and the market conditions, all of those are put together, right? And the investment banker's job is to run a process, right, that is going to maximize the client's objectives. And that process doesn't always have to be an auction. So I want just to think about a couple things before we begin, and we think about when M&A can actually add value. The first thing I want us to think about is the role of the market conditions, and then thinking about the role of the process, okay? Both of those together, coming together to create a transaction. But we got a lot of great answers here. Diligence, I'll just mention diligence for a second. Diligence is really the responsibility of the company. So when you think about investment bankers, so I'll just pause on the slide for a moment because people have sometimes different notions of what it is that the bank actually does. So the investment bank, unlike the board of directors, right? So the board of directors has a fiduciary duty to the shareholders. And that's true whether the company is a public company or whether it's a private company, right? They have a duty of trust and confidence. The banker's role, whether that banker is working for the seller of the asset, so a so-called sell side assignment, or they're working for the buyer, a so-called buy side, is governed by the terms of the contract, which is called the engagement letter. And typically in US deals, in terms of the engagement letter, the banker will specifically say, right, that the due diligence is on the company. We may be doing due diligence, right? To the extent the banker's doing due diligence on the sell side, it's due diligence for the banker to be able to perform its obligations to the seller, right? And that obligation to the seller is to run the process, right? That's going to optimize the seller's objectives, given the market conditions and the nature of the asset. So the banker is not really performing a valuation, right? The banker may give some points of view as to what value might be or likely valuations that could be achieved based on different processes, but it's not a valuation sort of straight up as we think about it. And I just would like us to just keep in mind too that from a diligence perspective, the diligence issue is really the diligence that the banker's doing for the banker to be able to complete their engagement. Okay, complete their engagement. Okay, so we've got both of those things down. Let's talk a little bit about sort of market conditions and trends. And so what I'd like us to think about here are really three things, right? And the first thing is that M&A is a market for corporate control. And I think that's a useful thing to keep in mind because everything that impacts a market, right, is going to impact M&A. So people often ask, what's the impact of interest rates, right, on the M&A market? Well, what's the impact on interest rates when you go and buy a house, right? Or when you're going to go maybe finance a car or make another major purchase that requires financing. So it's important and helpful when we ask those questions to just say, okay, well, everything that affects a market will affect M&A because it's simply a market, but the market here is the market for corporate control, to control the particular asset. And when we're buying control, that implies something else, right? The fact that we're buying control implies a premium, right? So if the stock or the company's intrinsic value is 100, we, as the buyer, it's going to be very unlikely that we'll be able to wrest control of that asset for 100. We're going to have to pay some level of a premium. And this is more of a broadcast, so I'm a kind of an interactive person, so I can't really ask you to put it into chat, but otherwise I would ask you to put in the chat what you think the average M&A premium has been over time. And it's interesting, the average M&A premium, so maybe you can just think about that in your head, and I'll tell you what the answer is. The average M&A premium over time has been about 30%. And that number's been fairly resilient, whether it's a stock deal or a cash deal, and irrespective of sort of the market climate when the transaction happens, it's a fairly decent number, 30%. So I just want you to think about that for a minute, right? You're buying an asset, and that asset has a value, right? And we can think about value in a bunch of different ways, right? We can think about it as a stream of cash flows over a period of time, and then some estimate of a terminal value. So we can think about it as a cash flow valuation, or we can think about it as a multiples-based valuation, meaning we could say, okay, what have other companies traded for in the public market and apply that multiple? That'd be a comparable trading analysis. Or we could look at what other companies have sold for, right? Similar companies have sold for, and look at a comparable acquisition analysis. But if we look at just the basic valuation of that company, right? That let's just choose a round number, 100, and we say, okay, this company's produced cash flows and has some estimate of terminal value which support a $100 million valuation. I'm now going to pay a 30% premium for that. Okay, so I am going to pay, right, 130. So these cash flows are only supporting 100. How am I going to capture that extra 30? So I want us to think about that, because that's really what makes M&A difficult, right? So when is M&A a competitive advantage? It's a competitive advantage when it works. When does it work? It works when you can capture that extra premium that you're going to need to cover the premium that you pay, the extra cash flow that you're going to need to cover the premium that you paid for that company. And that's very difficult, right? It's particularly in public company transactions, because the persons, right, those are synergies that we're going to need to capture, and the people that can create those synergies, we don't know those people until the deal closes. Because any of you on the broadcast here that have been involved in public company deals, you know that you can't really get the sales teams together, you can't really talk to the folks on the other side because of Hart-Scott and other prohibitions, right, until that deal closes. So it's very, very difficult as you think about where those synergies are going to come from. The second thing we want to think about is also thinking about a market is who are the players. Broadly speaking, we can think of the players in the M&A market as strategic bidders, right? And financial or private equity bidders, if you will. And whether you're a strategic bidder or you're a private equity bidder, you still have to overcome, or recapture, I should say, that premium that you're going to pay. So both parties have that. But when you think about market players and you think about private equity, they have additional burdens that they're carrying when they decide to buy a company, right? They have the burden of an existing management team, right? Can I work with this existing management team? Sure, I may be able to add new management to that, but it's kind of hard given where my sort of exit strategy is going to be for this company if I have to wholesale replace a management team. So I have to have a management team that I can back as a private equity firm. I have to have a company where I can put leverage on it, and that leverage is going to pay down, right? And I have to have a company where I have an exit strategy. How am I going to own this business, and what am I going to do to this business that's going to make it different in the next, 3, 5 to 7 years? And not make it different that I wring out every last ounce of value, but that I make it different and there's something left on the table for the next bidder. So that's a heavy lift. And the reason I mention market players is because something is worth what someone will pay. So when you think about investment bankers running a process in a sell side, one of the most important things that they're going to do, and that gets us to our third point here, is setting up a process that's appropriate for the asset and thinking about who the bidders will be. Now you might say to yourself, Donna, that's not that difficult, right? I mean, come on. We all know who might be interested in this asset. We can think about it strategically, right? And that's true. But selling a business is, and for any of you on the broadcast here who have done it, is incredibly disruptive, right? Employees find out about it, they might leave. Your customers find out about it, they might leave, right? So you want to try to keep it as targeted as possible. So hiring a banker that really knows the space, right, that really knows the individual area and has sold businesses there and really knows and has a deep understanding of who those potential buyers would be is really what is critical in the M&A process. So is the past prologue just a little look at for folks to go back to our original question, because the market conditions are important because M&A is a market. And so one of the big things that impacts markets, and we see this a lot, is confidence, right? How do people feel? And that's why I asked you the first question when we began today. about what you guys think about how the market is going to perform in the next 18 to 24 months. So we had a few folks that said absolutely it would be higher. And this is the number to beat for those of you that had said it's going to be absolutely higher. On a global basis, we had about 2.9 trillion in M&A value, which was down about 18% from 2022. So this is an excellent website for any of you that want to look at it. You'll see, as Mark mentioned, the slides will be available after the program, and the program is recorded. But I would check this out. You can get it at Wall Street Journal, and they update it constantly about M&A activity as well as IPO markets, debt markets, et cetera. So it's a really good source to get a pulse on where activity is happening and also what the largest deals have been. It's Dealogic's investment banking scorecard from the Wall Street Journal. So if you take a look at that globally and you see where the U.S. is, a little less than half of the overall M&A activity, all right, and you can sort of see the contributors, but everybody was kind of in the red last year with the exception of Japan, okay, Japan, and 2.9 billion. So that's the first, a trillion, excuse me. That's the first time we've fallen under 3 trillion in quite some time. So for those of you that think that we are going to absolutely beat the market next year, here's where we are through June 12th. Okay, globally we're at we can call it 1.4 trillion if you'd like. And so if you sort of analyze that, it doesn't look like we're going to beat the market. But again, you know, the summertime is kind of a lull in the M&A market and deals come through at the end of the year. And remember, this is announced M&A transactions. Okay, so when you look at typically at data around this kind of information about M&A, it's typically the announced transactions that make up the data. So what does history show us, right? And if you look at this chart, I think it's a great chart here. This is like the only time in my life that I ever had really good timing. I started in the M&A market. I started as a lawyer, as Mark had mentioned, back in the late 80s at Skadden Arps. But then I graduated Columbia Business School in the early 90s, 1990, and I rode this trend right up to the top, right up to a little over 2000, right? And so you see, we were on a sort of a 10-year, just kind of up, 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 up. Then we had in 2000 and 2001, you may recall the internet bubble, right? We had the internet bubble. There was a reset. And again, up, 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 right? Then we had, you know, fairly steady years after that. And then the great financial crisis, right? 2007, 2008. And look how high it was before, right? The great financial crisis we can think about is sort of May of 2007, right? Going into 2008, it precipitously went down, right? And then a build up back up. So you see these peaks and troughs in M&A activity. Why? It makes perfect sense because it is a market. It's a market for corporate control, right? Trees don't grow to the sky, M&A doesn't grow to the sky. It is an overall market for control, and keep in mind everything that affects the market affects M&A. And one of the big things that affects the market is the state of play of the buyers. So you may also remember SPACs, when SPACs were hot and popular, right? When everyone was talking about SPACs, special purpose acquisition corporations, there was a lot of M&A activity. Why? Because the way a SPAC works, again, if this were interactive, I'd ask you to put in the chat why. So I'll just say why. Because the way the SPAC works is that if the SPAC didn't make an investment, right, special purpose acquisition companies, right, that they went public, they had a pool of money, and they couldn't have their acquisition ideas ahead of going public. They went public with the concept, we are going to buy healthcare companies. So basically you were backing a management team who was then going to go out and buy a particular type of asset. So as they came up against the time period where they had to de-SPAC or commit the money, there was a flurry of purchasing, right? So again, understanding market conditions in market players, right? Understanding that M&A is a market and that everything that affects the market, right? Interest rates, confidence, what's going on with the individual players will ride M&A activity. So when does M&A work, right? When does M&A work? I find that it works, and I can define works for you if you'd like. I mean, works is I have made an investment, because if you think about it this way, M&A is simply an alternative to organic growth, right? So I can build this functionality or I can buy this functionality. So when is it going to make sense for me to buy the functionality? It's only going to make sense for me to buy that functionality when I am able to purchase it and generate a return, right, for my investors greater than what my investors are demanding, right, my cost of capital. But moreover, I also have to recapture any incremental amount that I paid for that asset above that asset's intrinsic valuation. And that's not easy to do, right? That's not easy to do. We all talk about synergies and we can model synergies, but another takeaway I hope you get from today's webinar is that people create synergies, not spreadsheets, right? People create synergies, not spreadsheets. And you're like, oh yeah, right, well, great, Donna, fabulous. That's true, but people forget it all the time because the people that you're going to need on the ground of that transaction to create those synergies, you as the acquirer are not going to get to meet or talk to necessarily, particularly in a public company transaction, until the deal has already been signed up. Okay, till the deal's already been signed up. And there are some strategies that we can talk about on how you can seek to ensure that happening, right? One of the big things that I like to talk about when I teach the M&A class is to talk about how the triumvirate works together, right? The triumvirate in my book is in the middle, you have due diligence, then you have valuation, and you have deal documentation, right? And they constantly are, it's a feedback loop, right? You do the due diligence, it helps inform what you're going to pay in value, right? And what you're going to pay in value, you're only going to pay if you get the benefit of the bargain. What does that mean? That means you got to work on your M&A contract, right? You got to work on your merger agreement. So those three things are very, very important, and how they fit together can help you maximize the value of the transaction. So what are the truths that I have? And then it leads to the bottom line of when M&A is going to work, i.e. when it's going to be a competitive advantage for you. When you realize that it's simply one of the strategic alternatives available to the firm, right? The firm needs to think about both the acquirer, right, the buy versus build from the acquirer's perspective, and from the target's perspective, am I getting a return if I, fold all my cards here, right? Are my shareholders getting a greater return than I could produce for them, right? So that's the basic corporate finance decision, right? If you think about it as a pure corporate finance decision, right? What the buyer should be thinking about and what the seller should be thinking about. But what makes M&A so fascinating and why I loved it and still love it so much is that it's not about solely corporate finance, right? It's not about, okay, great, we met our cost of capital here and a bit, we've got to exit the investment. M&A is about people and money. And when you put people and money together, anything can happen. And it does. In the time between being a lawyer and a banker, I've seen quite a lot because it's about people and money at the end of the day. So we can think about it as a strategic alternative for both the buyer and the seller. Make sure you understand their motivations. We talked a little bit about how it's a market for corporate control. And so anything that affects a market is going to affect M&A, right? Interest rates, sentiment, who the buyers are, who the sellers are. We talked about value creation, right, by making the incremental cash flows bigger. And we can talk about that because we can think about the three main categories of synergies. They are revenue, cost, and the one I like best because it doesn't involve people, right, and people are risky, is balance sheet synergies, which can be receivable collection more quickly, right? Maybe you could pick up your receivable collection or turning your inventory more quickly, so better inventory management. Those are sort of low-hanging fruit ways, particularly if it's a larger company buying a private company or a smaller company, and the larger company has a better MIS system, right? Management system of information there. They can create that synergy that doesn't require, selling more widgets or terminating, redundant assets. And then keeping in mind, M&A is only going to create value when the present value of the cash flows, incremental cash flows, is bigger than the premium paid. And you say, well, Donna, how is that different than 3? It's different than 3 because it has in it the discount rate, right? And so discount rate reflects risk. If you think about synergies, there are 3 parts, right? You identify them, probably not too hard. That's a redundant asset, right? And you estimate. Okay, that's a redundant building. We don't need 2 headquarters. We call the real estate agent. This is what they could sell it for, and this is what we should net on an after-tax basis. The hardest of these is the execution part, right? Are we actually going to be able to sell that building? Are we actually going to get buyers? So those are the 3 parts: the identify, the estimate, and the execution. And it's in that execution piece that you're picking up the discount rate or the risk, okay? And finally, this all leads to the bottom line, right? The sort of answer to when M&A, or how you can optimize the chances, how you can optimize your chances for M&A working. I mean, this is not rocket science. You probably figured it out a long time ago. Price is critical in an M&A transaction. The higher price you pay, I like to say, the more things have to go right, right? You need a cushion. If you pay a full price for this asset, right? We never like to say you overpaid, right? So we say you paid a full price. If you pay a full price, the more things have to go right. You don't have a margin for error. That's why if you look in the Wall Street Journal, when they announce a deal, very generally the first paragraph is going to talk about what the acquirer paid and what that premium represents relative to other transactions, right? Because the market doesn't have an idea about synergies. They're like, I don't know anything about this company. I mean, I kind of see it, how the deal makes sense, but they have an intuitive sense of what this premium is relative to other premia that have been paid. And when you think about that and you put it in the context and you say, oh my gosh, these guys just bought a company for 9.5 times. Nobody's ever paid more than 7.5 times EBITDA. The market's going to not necessarily, the market is more likely than not going to have a less than favorable view of that, which will be reflected, if it's a public company, in the acquirer's stock price. So I hope I gave you a couple of pearls or thoughts, at least some thought-provoking ideas about what's going on with M&A. And I'm going to invite Mark back now as we turn it over for time for questions.
Hi, Donna. Thank you. I'm back. Yeah, you've covered so much so quickly, but as you can imagine, we've had quite a lot of questions coming in during the last half an hour. So if you're up for this, let's see if you can tackle a few of these questions in the remaining minutes.
Okay, is this going to be Stump Donna? Is that what you're going to do, Mark?
Exactly. Yeah, we're going to hit
All
you
right.
with a few straight away. So Emma asks, this came up a lot actually. So what is the role of artificial intelligence in M&A, and will it really transform future trends in M&A?
I think one of the most important things in M&A is really to understand the fundamentals, right? That it's about people and money. And if you understand the right questions that you should be asking, I think the artificial intelligence can be very helpful. But if it's sort of just like as a deal search tool or something like that, I'm less sanguine about that. You really need to make M&A successful. We need to think about those 4 points we mentioned, and you need to think about your deal thesis and what are the risks to your deal thesis. So to the extent that artificial intelligence can help you, fleshing out your deal thesis or what could be possible risks to that thesis, I think it'll be quite useful. But you have to have that good thesis first to begin with.
Okay, very clear. Alan asks, what do you perceive as the red flags that may mean you want to walk away from a deal?
That's a great question. And I think what happens, and because M&A is about people and money, I don't know if I'm a people, right? So I've bought stuff and I can get, talked into anything, right? You decide you want to buy that car and you walk into the dealer and you got a budget and then all of a sudden you're upsold, right? So, I mean, I think the red flags, you have to go into a transaction. It's very hard, disciplined with, like, these are the 5 things that if they're not true, it blows my thesis out of the water, and just stick to that, right? That I need this to happen, and kind of have that budget and have that discipline, and that's really, really hard to do in a transaction. But that's really the red flags would be any one of those things that are critical to your investment thesis not coming true.
Okay, very good. Jennifer asks, on balance, which do you believe are most successful, small acquisitions or go big, go home acquisitions?
So there's actually data on this, believe it or not, and the data suggests that there is some benefit to repeat. Now, obviously, everything is a little different, right? This is not a global answer that's going to answer every situation, but on average, the data has shown that folks that make incremental acquisitions over time tend to be more successful. There's this idea that there's repetition, right? Builds some deal understanding and deal judgment. The big whenever I hear the word transformative transaction, I get a little nervous. Right, people, the bet the ranch is always a little bit risky.
Okay. And last question, just conscious of time. Patrick asks, what impact does the current interest rate environment have on the overall outlook of M&A activity?
I think that it's very difficult to talk about a specific period of time, but I will give you the following, which is, deals get done in good markets, they get done in bad markets. What the markets hate are uncertainty. And, it's very difficult to plan with uncertainty. If you know the interest rates, look, a good deal is going to get the financing, right? It's a good deal. But so basically these difficult times really flush out some of the less attractive transactions. But on balance, the market's okay with interest rates and things as long as they kind of know where it's going, right? They don't like the uncertainty.
Okay, that's great. Thank you, Donna. You're off the hook. That's
I'm off the hook.
yeah,
Hopefully it
the
didn't
opening
stump me.
questions, but yeah, our time is up. Thank you so much for your session. We're now really looking forward to your new M&A and corporate strategy program, which is a new open program that's going to take place in person on campus here in New York this September. So for everyone on the session, more information about Donna's program will pop up in your email in the coming days. And of course, we'd really love for you to join us on campus to learn more about M&A with Donna. So all that's left for me is to say thank you very much for joining the session today. We hope you've enjoyed it, and we look forward to welcoming you here at Columbia Business School. Thank you.
Okay, thank you, Mark, and thank everybody at Columbia for making this happen. And thank you most of all for taking your time to spend with me today. Have a great rest of your day. Bye-bye.
Thanks, Donna.